This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Daniel's picture saying, looking for the downloads. Eric, let's start with crude oil.
Due to releasing the show a day early this week because of the American holiday, we don't have any EIA inventory data to share with our listeners this week. API, that's the private inventory service, reported a very large crude oil build of over 9 million barrels, but that was offset by large product draws. But the driver behind the rally we've seen in oil prices this week has entirely been expectations around OPEC Plus meeting on Sunday, and what I think is frankly some nonsensical rhetoric about weaponization of oil prices by Arab states. As I said in the feature interview, OPEC Plus should cut production because that's the prudent and responsible thing for them to do in the face of rising geopolitical risks and insufficient spare capacity to respond to a true geopolitical crisis should one arise. The reason I'm concerned that they might not cut production is that they have a strong incentive, per Dr. Anas Al-Haji's arguments a few weeks ago here on Macro Voices, they have a strong incentive not to be perceived as weaponizing prices. And that's the nonsensical conclusion that Western analysts would reach if they were to do the right thing and cut production in the course of their normal function of managing the market for prudent and responsible reasons. Thin liquidity on Friday could open the door to a big move in either direction if there's news. In the case of a big move up on weaponization fears going into the weekend and Sunday's OPEC Plus meeting, I'd be inclined to fade any move higher into the close, especially if it's brought on by geopolitical news from the Israel-Gaza conflict.
So Eric, on page 2, I have that chart on crude, and with that 50-day moving average, it's so clear that we are no longer even just in a retracement, but some very deep reversion back to the summer lows. The bigger question in my mind, are we going to see testing down under $70 for a full retesting of that support line, or are we going to start seeing oil start to base here? What is clear is with this type of a deep breakdown, in my mind, it's going to take a basing formation to once again turn this trend bullish. At best, in my mind, is we're going to be far more trade range bound for the rest of the year, and it will take a base into the start of next year to potentially see a more meaningful new trend emerge. Nonetheless, let's move on to equities. I want to get Nick involved in this conversation. Nick, let's start off just by talking about the levels you're looking on the S&P 500.
Yeah, Patrick, happy Thanksgiving. And let's get into it. So the spot price right now on SPX is approximately $45.50. We have a call wall above at 4,600, just below that year high, 4,609 area. We have a put wall below at 4,400. And the implied move for the December 15th OPEX is plus minus 100 points. Therefore, the upper expected move is 46.50 and the lower expected move is 44.50. Key resistance above is at 4,600 where the call wall is, and key support is below at 4,500. Now, given this sharp rally, which has caught a lot of people off guard, I'm inclined to think we see a pullback. I think the 44.50 area would be a good target in the next couple of weeks. And right now, I'm pretty bearish short term. But again, I do think we see that year-end rally perhaps to 46.50. What are your thoughts?
Oh, you know what? That's not far off from my thinking as well. The only issue I have with it is that it seems to be an increasingly consensus view, and rarely does the market do what everyone views as the most obvious move. With that said, we are definitely trading at the summer highs, and that is usually a point of overhead resistance. It is a typical place to see that retracement. The 50-day moving average lies a little bit lower than your number, around 4,400. So 100 to 150 point pullback shouldn't surprise anybody. But the view really should be that this is no longer just a bear market rally bounce, but rather a trend. And that means that this may remain in the upper boundaries of these area for the rest of the year. And the curious question is, could we see a rally that goes all the way back to the 2021 high near 4,800? As improbable as I think it is, it really is the path of least resistance. It'll be interesting to see whether the bulls can pull it off. The part for me, though, inevitably, we're still going to see some sort of an economic recession. We're going to see at some point corporate earnings get impacted. And at some point, it's going to lead to some sort of a bear market decline. But clearly, 2023 was not the year that it was all beginning. And so we're going to have to see where this trend finishes off and then how it transitions into the new year. Let's move on to the NASDAQ here. And what levels are you watching on the Qs?
Spot price right now on the Qs is approximately 390. We have a call wall above at 400 and a put wall below at 380. Now, the implied move for the December 15th monthly OPEX is plus minus 12 points. Thus, the upper potential move would be 402, just below the all-time highs at 408, 409. And the lower potential move would be at 378, which is just below that key support area of 380. Right now, resistance above is at 400, which is only about 10 points from the current price. NVIDIA reported earnings last night. Solid report for sure, but the valuation, I think, is very stretched. And I think big tech, given how far it's run in the last couple of weeks, has a bit of cooling off to do as well. So I'm more inclined to look at the small caps in the form of IWM. I do like it toward around 185, 190, but I'm not that bullish right now on big tech. I think that if anything does fall, it'll be the big tech names. Google, Apple, Microsoft, NVIDIA, they've all had substantial runs, and the valuations, I think, are very, very stretched. And I'm not very bullish on those names right now at all.
Well, in principle, I want to agree with you. The one thing in my mind, though, is the trend and the money flow has been chasing these Mag 7 stocks. And until I see them truly run out of momentum and start to roll over more decisively, will I kind of put more action toward that idea. To me, right now, they've been the leadership. And one of the biggest trades is going to be later in December or January when we potentially see that leadership shift. Maybe it's going to be the bond proxy, beaten down defensive sector that starts getting flows, and we see distribution in the Mag 7, and maybe that's going to make the indices very heavy. But that's early speculation, and I'm going to be looking for more technical signs when that kind of a thesis actually starts to emerge. Well, what I want to move on here with Nick is volatility index on page 6. And boy, did vol conditions collapse. Like, I thought it would take us deep into the holidays to see VIX on a 12 handle. And yet here we are after a huge rip in the markets, and volatility just imploded. While you can talk about the fact that this was where the year lows have been and that resistance can hold, with the speed and velocity which we got down here, it's certainly asking the big question as to whether we might see an 11 handle on the VIX in the weeks to come. How do you look at the volatility here?
So right now with the VIX at approximately 12, the expected broad market moves each day, top to bottom, are about 0.75%. Looking at the options on SPX, which the VIX is predicated upon, it's very interesting because the SPX call options are pretty much pricing in a perfection move to the upside. So what I mean by that is that if you're bullish right now and you're buying call options on SPX, you need basically an excessive move to the upside in order to win because calls are priced so highly right now. Conversely, puts are much, much cheaper than they usually are because a lot of people are not chasing puts in the form of insurance right now, which is very, very interesting. But as we've seen in the past, the VIX can pop very, very fast on exogenous events. And so I expect that in the next couple of months, we'll see a pop towards 16 again. I don't know what the catalyst will be, but I think right now it's very prudent to perhaps go long options on longer dates, out of the money put spreads perhaps, or call spreads if you're bullish. And selling premium right now is not very prudent because premiums are very, very low on larger than expected moves intraday. For example, a 1% move up or down, that'll burn most option premium sellers.
You know, what's interesting, Nick, is that as you say that, I was looking at 1-year volatility, and we're right down to the bottom end of the range where we were in the summer again. We have 3-month vol ranges down to the 15 handle. Like, it really is a complete collapse of volatility right across the board. This isn't just like 1-month seasonal volatility that is as narrow as it is. It'll be really interesting to see how it plays out.
Now, moving on to page 7, we have the US dollar index. Eric, what are your thoughts here?
We see a nice new downsloping price channel setting up on the dollar index. We just touched the bottom of that price channel, the channel support level, as we touched or almost touched 103 on the dollar index. We're bouncing predictably here, but as long as we stay below 104 spot 50 or so, we're still in that steeply downsloping price channel, and it's just a question of how much lower we go before we see a change here. I don't have a downside target. Curious to get your views.
You know, the 105 level was important. It was where a lot of resistance lied in the first and second quarters of the year. But what is interesting is that the euro and even the yen have approached some key retracement zones. And what we're seeing here is that this pullback, if the dollar pullback is just a retracement, should actually start to put in some lows right around here. To me, very similar to the key levels when we were in the 80s on crude oil. It's the crossroad where it's either a pullback in a primary trend higher, or it's a full reversion and going to test previous lows. And I think the dollar is exactly at that inflection point. And so if the bulls can hold the line around this 104 and trade it back to 105 and start to consolidate it here, then a rising dollar is still not off the table. But it is definitely a very key moment in the dollar.
Now, moving on to page 8, we have the gold futures chart. What are you guys thinking here?
The gold chart looks great, with gold holding over the short-term moving averages on a closing basis. The next hurdle is closing over the October high at 2020 on the December contract. If we can achieve that, the next targets higher, our first new all-time highs at 2085, and then a measured move target all the way up to 2140. That's 2140. Some observers see the 4-day ceasefire in the Israel-Gaza conflict that was just negotiated by Qatar as a sign of de-escalation and therefore potentially a bearish impulse for gold. But I don't see it that way. To my understanding, Israel has reluctantly agreed to this ceasefire because of international pressure to focus on hostage release. Once the hostages are released and the ceasefire is over, I expect the conflict to fully re-escalate, and that may provide the catalyst needed to break above 2020. Once we make that break, the next stop should be 2085. So let's keep a close eye on the chart, but if we can get above 2020, I think this is a very bullish setup.
Generally, I agree with what you're saying there, Eric. Overall, gold is in a primary trend higher, especially if you look on the weekly and monthly charts. Even on the monthly charts, we're trading right along the very key levels of the bodies of all the candles. But this 2000 level is, to me, also a very psychological level, because if gold sustains above 2000 on any long-term basis, then it really puts in motion the trends where at this time around, I seriously doubt the previous highs around 2080, 85 are going to hold. I think this is a very important moment to see whether or not the bulls can break this out and let it run. I think you use the 2000 level as a clean pivot for whether the trend is broken out. On page 9, I have the U.S. government 10-year bond yields, and it really does look like that 5% marked the blow-off top in the yields. Now, what will be really interesting as we see these weaker inflation prints, what the next rally in the yields will look like. If we see that the bond bears can't get the bonds back down to the lows or the yields back up to 5%, that might put in a short to intermediate high in yields, which would be huge, because that would really put in play all of these bond proxy assets that were under pressure with the rising interest rates. It's certainly something I'm watching very closely. And finally, on page 10, I wanted to touch on the uranium chart. For the purposes here, I put on the Sprott Physical Uranium Trust. But this trend is relentless. Higher highs, higher lows. We continue to see now uranium above $80 on the U308. It is a trend that is dominant, and while it seems overbought, it's getting a lot of attention in a very small market. And it'll be interesting to see whether flows can continue this and turn it almost into a bubblish rise. Watching uranium is key.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.